Yelp just beat Q2 consensus. I mean, revenue came in at $375.52 million. That is a 1.4% year-over-year increase, which beats the $366.89 million estimate.
Right, and earnings per share absolutely crushed it. We are talking $0.57 gap against a $1.36 consensus.
Yeah, but the forward guidance tells a much more complicated story. Q3 revenue is guided to between $355 and $370 million.
And adjusted EBITDA is looking at $70 to $75 million for Q3. Plus, management narrowed their full-year 2026 revenue to a really tight window of $1.46 billion to $1.47 billion.
And if you track the stock reaction, the market clearly didn't know how to digest those mixed signals.
Not at all.
The stock fell 2.53% in the regular session right before the print, popped 1.96% after hours to $25.53, and then closed the next day on Friday, up 2.08% at $25.56.
And that was on incredibly heavy volume, right? Like 2.13 million shares changing hands.
Yeah, which is more than double their normal daily volume. Institutions were aggressively repositioning. So if you are a retail investor holding Yelp in your portfolio right now, do not let that headline EPS fool you. What we are doing a deep dive into today is a company fighting for its absolute life.
Yeah, we're looking at a business attempting to just rip out its legacy advertising engine and replace it with an AI-driven software and data licensing model.
And they're trying to do this while the plane is still in the air.
It is a massive structural transition. The financial metrics we just laid out, they really reflect the severe growing pains of trying to fundamentally change how a 22-year-old internet company makes its money.
So let's start with how Yelp actually pulled off that top-line revenue beat. Because honestly, the underlying details are alarming. The core business, the traditional advertising engine that made Yelp famous, it's shrinking.
It is under severe macroeconomic pressure right now. Let's look at their services ad revenue. This is the money they make from plumbers, electricians, roofers buying sponsored placement.
Right.
That segment was completely flat at $241 million.
And flat is actually the bright spot here.
It really is, because when you look at their other major category restaurants, retail, and other what they call RR&O, that ad revenue dropped a steep 10% down to $101.5 million.
Wait, a 10% drop? Why is that falling so aggressively? I mean, is it just competition from Google, or is something else happening to local restaurants?
Well, it's the reality of local business economics right now. Local businesses are feeling this compounding pinch of inflation, higher input costs for ingredients, and, fluctuating gas prices.
Right, the margins are getting crushed.
Exactly. When a local restaurant or a boutique retailer sees their profit margins get squeezed, the very first thing they cut is discretionary marketing spend. They simply cannot afford to pay Yelp for clicks when they are struggling to meet payroll.
That makes sense. And you can see that pain reflected clearly in the engagement metrics across the platform. Ad clicks are down 5%.
Yeah.
And paying advertising locations, what Yelp calls PLs, basically the total number of businesses actively paying them, that dropped 1% to 510,000.
No, management did manage to tick the average cost per click, the CPC, up by 1%.
Which provided a tiny bit of buffer, I guess.
A tiny bit, yeah. But the overall volume of activity is undeniably slipping. The traditional search and click engine is sputtering.
But they still managed to beat the street.
Right, and they beat it because of a single line item on the income statement simply called other revenue.
Which just exploded. I mean, it was up 98% year over year to $33 million.
It nearly doubled. And more importantly, this wasn't some accounting fluke or a one-time tax benefit. This growth was driven by a few highly specific strategic operational moves.
Okay, like what?
Well, first, they were seeing real revenue realization from their recent acquisition of a company called Hatch. Second, they are aggressively expanding their data licensing through the Yelp Places API.
Oh, right.
And third, they have a highly lucrative food ordering partnership with DoorDash.
Look, seeing these numbers, this feels exactly like looking at a dying legacy brick-and-mortar store.
How so?
Well, the front-of-house foot traffic is dead. The shelves are dusty. But suddenly management realizes the B2B side hustle operating out of the loading dock in the back is absolutely booming.
That is a great analogy.
But come on, can a $33 million loading dock side hustle realistically carry a $1.4 billion company? Yeah. Especially when the core RR&O ads, the historical bread and butter, or melting down by 10%.
And that is the multi-billion-dollar question for anyone holding this equity.
Yeah.
To understand management's gamble, you have to understand the difference in the quality of that revenue.
Quality meaning stability.
Precisely. Yelp is actively trying to pivot away from relying purely on local ad budgets because, as we just established, local ad budgets are incredibly volatile. If inflation spikes, that ad budget vanishes overnight.
So they want to replace volatile marketing dollars with what exactly?
Yeah,
Software budgets.
Exactly. They are building stickier subscription and licensing models. Let's look at Hatch, the company they acquired.
Right.
Hatch provides AI lead management software for home service contractors. When Yelp sells a Hatch software subscription to a roofing company, that tool becomes an operational expense for the roofer.
I see.
It's the CRM they use to manage their daily workflow, track leads, and communicate with customers.
It's much harder for a small business to cancel the software that literally runs their back office than it is to just turn off a Yelp ad campaign.
Exactly. It's high-quality, recurring revenue. And the same logic applies to their data licensing. Selling access to the Yelp Places API to enterprise tech companies provides a massive, stable revenue floor.
Right, because they sign multi-year enterprise contracts.
Yeah, contracts that do not depend on whether a local bakery wants to spend $50 on ad clicks this Tuesday.
But Yelp isn't just taking that API and software revenue and sitting on it. They are immediately deploying it to solve their biggest existential threat, which is their aging infrastructure.
And you can see the immediate toll that is taking on their profit margins. Building out this new B2B tech stack is incredibly expensive.
Yeah, the bottom line took a serious hit. There's no way around that for investors. Net income fell 28% year over year to $31.7 million.
Which compressed their net margin from a healthy 12% down to 8%.
Adjusted EBITDA also fell 9% to $91.4 million. Though, if you're looking for a silver lining, we should note that this EBITDA number still beat management's own high-end guidance by $16 million.
That's true. Delivering a 24% EBITDA margin under these conditions means they are managing the internal declines significantly better than they projected a quarter ago.
They are keeping the ship afloat. But the broader trend of margin compression is undeniable. Operating margins dropped from 14.4% to 11.6%.
And this is happening because Yelp is shoveling massive amounts of capital expenditure straight into artificial intelligence.
Right.
They are heavily funding R&D, product development specifically to integrate Hatch, and launching consumer marketing campaigns to drive leads into these new systems.
So if they are sacrificing 400 basis points of operating margin for this, we really need to examine what they're actually getting for that R&D spend. What are they building?
Well, first, you have Yelp Assistant. This is their new conversational AI, and management noted it is now driving 10% of all request-to-quote projects on the platform.
10%. That is real, measurable traction.
It is, and the mechanism behind it explains why it's working. Previously, if you wanted a quote for a new roof, you had to manually fill out a static form, describe your problem, and just wait.
Which is annoying.
Right. Now, Yelp Assistant acts like a virtual concierge. It asks you dynamic questions based on your specific project, gathers the necessary details, and automatically routes the request to multiple qualified contractors.
It drastically reduces the friction for the consumer, which obviously increases the conversion rate for the contractor.
Exactly.
Then you have Yelp Host, which I find even more fascinating. This is an AI-powered call answering service designed specifically for restaurants. It just hit an annual run rate of 2.4 million calls handled.
Wow.
Yeah, and that volume has tripled since January.
Think about the operational bottleneck of a busy restaurant on a Friday night. The phone is ringing off the hook, but the host is busy seating guests. Calls get dropped, which means reservations and takeout orders get lost.
And that's lost revenue.
Exactly.
Yeah.
Yelp Host uses AI to answer those calls. They just added 16 new languages to the system, and they integrated it directly with OpenTable.
Wait, so if a customer calls and asks for a table for 4 at 7 p.m., the AI doesn't just take a message.
No, it checks OpenTable, confirms the availability, and actually books the reservation directly into the restaurant system.
That's credible.
And it handles edge cases perfectly. If the caller has a complex dietary restriction or wants to request a specific table, the AI parses that natural language and adds it to the reservation notes.
That's wild.
Furthermore, this ties perfectly into that DoorDash partnership. Yelp Host now has full point-of-sale integration. The AI can take a complex phone order for food pickup, route the ticket directly to the kitchen's prep screen, and the restaurant doesn't have to pay any of the added delivery commission fees they usually lose to third-party apps.
That is a massive value proposition for a restaurant operating on razor-thin margins. You are effectively replacing the labor cost of a dedicated phone host with a Yelp software subscription.
Exactly. And the third piece of this AI build-out is on the enterprise side, the data licensing.
Right.
Yelp's reviews are currently powering ChatGPT's local experience, and they noted that a request, a quote, integration is coming to OpenAI very soon.
When you lay out all of those mechanical pieces like Yelp Assistant, Yelp Host, Hatch integration, enterprise licensing, it completely explains the margin compression.
They aren't just updating their app, they are rebuilding the entire operational infrastructure of the company.
On the earnings call, management stated they are targeting a $250 million annual run rate in this other revenue category by 2028, up from the current $33 million.
Which is a huge jump.
It is. Yelp is no longer trying to be the internet's yellow pages, just a static directory where you search a name and look at a banner ad. They are aggressively trying to become the actual operating system for local businesses.
Yeah.
They want to own the software that answers the phone, books the table, takes the order, and manages the leads.
And that operating system framework is really the only way to understand this stock right now. If we connect this to the broader financial picture, this is the exact narrative management is using to ask investors to tolerate the short-term pain of lower margins.
Right, because net income is down 28% today.
But if Yelp successfully embeds itself as the operational software for 250,000 local businesses, the lifetime value of those customers skyrockets compared to someone just buying a one-off ad campaign.
And there is a significant internal efficiency angle here that management highlighted too. All of this AI investment isn't just external facing.
That's a crucial point. They are deploying AI coding assistants internally. Management noted that these tools are making their engineering teams much faster.
So they are iterating and bringing new products to market at a speed they haven't seen in years.
Exactly, which is allowing them to keep their overall headcount completely flat even as they build out this massive new software suite.
So that introduces the potential for real operating leverage. If they can scale revenue up through these new high-margin software products, but keep headcount flat, those compressed margins will eventually expand again.
In theory, yes. But getting to that inflection point requires a tremendous amount of cash. You cannot fund a massive internal AI rebuild and integrate enterprise acquisitions without burning capital.
Which brings us to the bad news.
Right. That reality forced the most consequential disclosure of the entire quarter, a major shift in Yelp's capital allocation strategy.
Yelp abruptly paused its aggressive share buyback program. If you are a retail investor listening to this, this is the headline you actually need to be sweating over.
It is a massive deal for the near-term equity thesis. To give some context on how aggressive they were being, Yelp repurchased $50 million worth of stock in Q2 at an average price of $24.92 a share.
Wow.
And they bought another $25 million in Q3 prior to this announcement. So they had already hit $200 million in buybacks for the year.
And then they just shelved it. They have $339 million remaining on their buyback authorization, and management flatly stated that capital is locked up until at least 2027.
Yeah.
Why stop now? Right in the middle of a strategic pivot.
Well, they need the cash to pay down a $100 million revolving credit facility. Think of a revolving credit facility, like a massive corporate credit card.
Okay.
Yelp drew down on that facility to fund the cash portion of the Hatch acquisition. Now the bill is due. With interest rates where they are, management decided that carrying debt to buy back stock made zero financial sense.
So they have to prioritize paying off that credit card over returning capital to shareholders.
Exactly.
But what happens to a stock trading at an 11.1x price-to-earnings multiple when management suddenly takes away the sugar high of a share buyback?
Yeah.
Institutional investors have relied on that buyback program to put a structural floor under the stock price for years.
It fundamentally strips away the financial engineering that was propping up the valuation.
Let's break down the math on that for a second.
Sure. When a company is aggressively buying back its own shares, it artificially boosts the earnings per share. Even if your net income stays totally flat, or in Yelp's case, drops 28%, if you continually reduce the number of shares outstanding, the earnings per share goes up.
It makes a declining business look like a growth business on a per-share basis.
Exactly. But by pausing the buyback, management is sending a very clear signal to the market.
Which is?
First, they see a highly uncertain, tough macro environment ahead, and they decided that having deep balance sheet flexibility, being debt-free on that revolver, is far more important than propping up the short-term EPS.
Makes sense.
Second, it means the underlying business now has to carry the weight of the valuation on its own. The EPS growth has to come from actual operational software growth, not just from retiring shares.
And quite frankly, that actual operational growth looks highly suspect in the near term. Let's look at the forward risks baked into the Q3 guidance.
Yeah, let's look at it.
They guided Q3 revenue to a range of $365 million to $370 million. But if you look at what Yelp actually generated in Q3 of last year, this new guidance implies a year-over-year revenue decline of between 1.6% and 2.9%.
It is a stark reality check. The narrowed full-year guidance essentially confirms that the entire second half of 2026 is going to be flat to down compared to last year.
If you are an institutional investor, and remember, institutional ownership of Yelp is over 90%, you are looking at a company with a shrinking core ad business, a permanently paused buyback program, compressing margins, and negative implied growth for the rest of the year.
It's a tough sell.
It's really no wonder the consensus analyst rating remains a stubbornly pessimistic hold or reduce, with an average price target of $27.88, which is barely above where it trades today.
It is entirely a show-me story now. The institutions aren't going to reward Yelp with a higher valuation multiple until management can actually prove that this new operating system strategy, the Hatch subscriptions, and the Yelp Host AI is going to generate enough cash to outpace the rapid decline in traditional search advertising.
Which brings us to an incredibly dangerous, forward-looking existential question about this transition. I want to talk about their data licensing strategy, specifically the integration with OpenAI.
Okay.
Yelp is aggressively trying to be the underlying data layer for the entire AI ecosystem. But what is the logical conclusion of giving your data to ChatGPT?
It raises a profoundly important question about cannibalization. Yelp's historical business model, the one that still generates roughly 90% of their revenue today, relies entirely on a consumer opening the Yelp app, searching for a plumber, scrolling through results, and clicking on a sponsored ad.
Right. A click that might cost that plumber $50, which goes straight into Yelp's pocket. Highly monetizable, captive traffic.
But let's fast forward to 2028. A user is driving in their car and says to their voice assistant, ChatGPT, find me a highly rated plumber nearby who is open right now and ask them for a quote to fix a leaking pipe.
Okay, I see where this is going.
ChatGPT uses Yelp's licensed review data to find the plumber and uses Yelp's API integration to seamlessly send the, quote, request. The user gets exactly what they want without ever touching a screen.
The consumer never opens the Yelp app. They never see the Yelp interface. And most importantly, Yelp never gets the opportunity to serve that user a sponsored ad.
Exactly.
So, by chasing this other revenue licensing check from OpenAI today, is Yelp inadvertently cannibalizing its own core advertising traffic for the next decade?
Are they digging their own grave?
It is the ultimate innovator's dilemma playing out in real time. Management forcefully defended this strategy on the earnings call. CEO Jeremy Stoppelman argued that Yelp has a long history of syndicating its data to platforms like Apple Maps and Bing.
True.
He claims this acts as a top-of-funnel discovery mechanism, that when a user sees a Yelp review snippet on Apple Maps, eventually drives them to download the Yelp app to see more.
But ChatGPT is fundamentally different than Apple Maps. Apple Maps just shows you a location. You still have to take the action.
ChatGPT is an autonomous agent. It executes the task for you. If the AI agent negotiates the quote and books the appointment, why on earth would the consumer ever click a link to go back to Yelp's website?
That is the exact tension terrifying retail investors right now. But management's counter-argument is essentially that they have to do this.
Because if they don't,
If Yelp refuses to license its data to OpenAI, OpenAI will just find another data provider or scrape the web themselves, and Yelp becomes entirely irrelevant. By integrating now, Yelp is choosing to disrupt themselves before the AI giants do it to them.
it is a bold, high-wire strategy, but it completely explains why they're so desperate to become the operating system for the business itself, rather than just the consumer-facing search engine.
Exactly.
If Yelp controls the Hatch software the plumber uses to manage his schedule, and the Yelp Host software the restaurant uses to take orders, it doesn't matter if the initial lead comes from the Yelp app, Apple Maps, or ChatGPT. Yelp still monetizes the transaction on the back end.
Exactly. The front-end discovery interface might belong to OpenAI, but the back-end operating infrastructure belongs to Yelp. And that is why tracking the growth of that $33 million other revenue line is the single most important metric for any investor to watch over the next 4 quarters.
The diagnostic landscape for Yelp right now just isn't clean. The headline numbers might look like a simple beat, but beneath the surface, this is a company attempting a radical, expensive transformation in the middle of a brutal macro environment. and they're doing it without the safety net of share buybacks to cushion a fall.
It's a huge gamble.
It really is. Navigating these kinds of pivotal earnings reports requires daily attention. If you want to keep tracking stories like this and stay ahead of the market, make sure to follow the show for our daily earnings coverage. See you next time.